Hey everybody, it's Seth and Paul with the Everything Money Channel. On this episode right now, Paul discusses what the hell inflation is, what it means, how does it grow, up, down, sideways, what it means for investors in the economy right now on the Everything Money Channel. Let's do this, baby. Hey everybody, it's Paul and Seth with the Everything Money Channel. Thanks for joining us today. Today, Paul, you're going to talk about inflation. Kind of a confusing topic for normal people, I think, especially myself, most of my peers. It sounds bad. It's kind of good. Tell us about your thoughts.
So this came up because our good friend, DJ Access, Mike Salone, called me yesterday, and he was floored that I answered the phone. I said, well, yeah, if it doesn't say Seth, I answer the phone.
Right, got it.
So, so he called me yesterday, and he was talking about some of the videos. Then he said, hey, Paul, let me ask you a question. He goes, am I just crazy, or should I be worried about inflation because they're printing all this money and blah, blah, blah. I took Econ 101 and blah, 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 blah. It's a valid point. The point he was trying to make was the more money we print, the more inflation occurs.
Now, Elon Musk got hung out to dry last week because he said something in a tweet to the effect of, I don't think we should be doing another
stimulus package.
And all of my friends, you know who they are, Paul.
Yeah.
They just start laying into this guy. What a greedy asshole. He said it's not, something to the effect of, it's not best for us in the long run.
That is correct.
And that's what I thought too. Well,
we've talked about this before.
You're getting me to think in terms of
Well, I mean, listen, everything can be a good or bad thing. Like you said before about inflation is good, is it bad? I don't know. Everything can be good or bad. The question is, what's the surrounding story behind it, right? So this stimulus package, so what we're trying to do here, so 10, 12 years ago, we bailed out the banks. And I remember thinking back then, we're going to have a lot of inflation. It never happened. I mean, the last 15, 20 years, we had relatively low inflation, right? So inflation, for everybody who needs to understand it, is basically the cost of living and life going up, right?
Yeah.
So over time, things cost more money. It's incredible how much things will change. Like when your parents bought their house back in 1986, what did they pay?
$89,000.
And what's it worth today?
$350.
Okay, that's a lot. Now, granted, that's not necessarily inflation. It's more than inflation, but you look at things and say, over time, people make more money. When they make more money, they spend more. When they spend more, they buy more stuff. So the companies have more demand. They got to hire more people. It's a cycle,
yes.
a good cycle of everybody. So in order to entice more people, that's why when unemployment's low, wages tend to go up because you have to go pay more money to get the same people to come work for you, right? So is inflation good? It can be. Is inflation bad? It can be.
Wouldn't you say that inflation is a small, controlled, steady inflation is necessary for a thriving economy?
I won't say it's necessary, but it's fine if it's controlled. And so let's get right into that.
Go ahead.
So CPI is the U.S. Consumer Price Index. That's basically...
I'm confused already.
Yes. So basically the U.S. government takes a basket of goods, and every quarter and every month they track how much that basket of goods costs. And they call it the Consumer Price Index. And it's basically going to tell us, here's how much prices have changed, right? So in June of 2020, and actually the same as January 2020, that basket of goods was 257. That's just their index.
Okay.
In 1950, it was 2350. So since then, the cost of that same amount of goods has gone up 11 times.
11, yeah.
Right? So let's figure out, so I'm going to do a little math here. This is the math to figure out how much the annual change is. It's 257 divided by 23.5 to the power of 1 over 70. Now, why is it 1 over 70? It's been 70 years. So this is you don't need to know this equation, but I'm going to type it into our trusty calculator because you can do it on any iPhone calculator. If you flip it to the side, you go 257 divided by 23.5. And that equals 10.9 to the power of 1 divided by 70. And that is 3.47%.
Okay.
So it's roughly 3.5% per year.
Inflation.
So that means, essentially, in order to keep the same cost of living up from 1950 to today, you need to increase your income by 3.5% per year. And that would give you the exact same amount of buying power every single year. The same basket of goods in 1950 that cost $23.50 costs $2.57 today. Does that make sense?
Yes.
Are there any questions?
Same basket of goods. Got it.
The same basket of goods. And they throw a lot of things in that basket. They throw basically the things that are going on in that market, in that environment. And the basket of goods will change, obviously, over time, because you're not going to have a cassette player in 2020, but you might have it in 1980. So over time, we're going to get roughly 3.5% inflation. Now, where do we get into problems? Well, in the 1970s, if you remember, we had massive inflation, but it was very quick and massive. We had 15% inflation, maybe even higher. Why? Oil prices were skyrocketing. That hurt people because it's harder to make up for a 10% increase in your costs in 1 year versus a 3 or 3.5% increase, right?
Yeah.
If your costs went up 20% tomorrow, you'd be like, what the hell happened? And then if it stayed, let's say, for example, to slide this over, let's say you had 2020, you had a 20% increase, and then for the next 4 years, it was 0%.
Speaking of 20%, Paul, I'd love to see a 20% increase in likes right now. Please take a moment, smash that like button in the bottom right corner. It really helps. It really helps us. It helps with the YouTube algorithm, which no one knows what that is. But smash that like button. Paul, keep going about 20%.
So if you had a 20% increase next year in your costs, that means whatever costs you $10,000 this year would cost you $12,000 next year, but it had 0% for the next 4 years. Versus over a 5-year period going up 20%. 4% a year. Which one's easier to manage?
4%.
Exactly. Even though, we won't get the math of it, it's basically the same number. 4% per year is a much easier pill to swallow for everyone. Consumers, business owners. If all of a sudden I had to pay everybody 20% more, I'd be like, what the hell?
Can't do it.
It would be hard.
Yeah.
Because in future years, people would say, well, I make the same amount of money. Well, inflation's 0. You can't really do that. So slow and steady inflation helps your house price goes up, helps you to make more money, allows you to go, because remember when you buy a house, you're paying down the mortgage. The mortgage always stays the same no matter what inflation is, right?
Yeah.
Does your mortgage ever go up or down, the principal and interest?
No.
No. So that's why it's helpful for inflation. You're going to be, in year 15, you're paying down the same mortgage payment, even though your income in total dollars is actually higher. So inflation can be a good thing. With all this printing of money, though, to get back to it, basically inflation is driven by the supply of money. If there's a ton of money out there, what happens? Is it easier or harder to get money?
Easier.
Easier.
People are spending.
When it's easier to get money and the supply, as we all know, supply and demand, right? Supply and demand. When the supply of something is more, it shifts. What happens to the price?
Down.
So the value of the inflation is the value of dollars going down, right? Because if you remember in 1950, you bought for $23.50, you're buying the same thing for $2.57. It's hard to understand maybe, but this means the value of your dollar goes down. You have to spend more dollars now to get the exact same basket. So
that's right.
With all this printing of money, I don't see how it doesn't lead, because it's all going to the consumer, and the consumers are going to spend. And they're going to spend on things they need and want. And the easier it is to get that money, when we're printing all of it, the more prices are going to go up.
Now, there's more people in the world all making more money. Don't we need more money printed at some point?
I don't know that's
if we kept it the same amount, like Bitcoin, oh my God, it would just go up and up and up, Paul. You know, like
what is Bitcoin at today? But anyways,
11.5.
11.5. I don't. Money is, just because there are more people in the world doesn't mean you need more money. You're just dividing up the pie in different ways, right? We used to be on what's called the gold standard, where
till the 70s.
Yeah, until our good friend Nixon canceled it, where basically we had to run our money based on whatever goal is in reserve. And I don't know exact metrics behind it, but now we just print like crazy.
Yeah,
you're right. Can we just print like crazy? We need more money, sure, but then people would complain, people would be excited because, oh, sweet, minimum wage is now $20 an hour. Well, yeah, but now you're a McDonald's worker making $20 an hour, which means what? It means all of a sudden now to buy a burger, it's not 99 cents anymore. What is it? It's
$5.
now $3.
Yeah.
And then people would complain like, oh, Walmart sucks. It's like all these things. It's like, it's not just a one domino effect. There's so many other domino effects. Yes, people make more money, but then we're going to lose more manufacturing jobs in this country. Why? Because it's still cheaper overseas to hire somebody, et cetera. So
yes,
inflation in a slow and steady pace, 3.5%, if it's very consistent, can provide a lot of good for people. We don't want deflation. Deflation sucks because it's the opposite of inflation. So what does deflation mean? If inflation is the cost of things going up,
the reverse.
It's the cost of things going down.
This doesn't happen often, right? In the past 100 years, a couple times.
Correct. The problem with deflation is people put off a lot of spending because they're like, well, if I just wait 5 more months, it'll be cheaper. So it hurts spending. With inflation, the great news about inflation is, well, if I wait another year, it's going to cost me more money. I might as well do it now. I have the cash.
Yeah, so deflation means that the value of a single dollar bill is going up.
Correct.
So people would hold on to it because
correct. They'd be like, well, why should I spend today if I just wait a little bit? The cash is in my account. I'll be able to buy more in 6 months. Which you think to yourself, oh, that's wonderful. But it's just like when people say the value of the dollar. Oh, the value of the dollar was going up. Well, yeah, that's a good thing. Or it's a bad thing. It just depends which angle you're looking at it from.
Okay, keep going.
So with inflation, I'm all in favor of slow and steady inflation. I'm all a big fan of it. I just don't see how printing more and more money in the long run is going to do well for us. Because not only do we have that more money in the supply, and therefore the value of the dollar is going to go down, we still have that debt we have to take care of. Where's that money coming from? It's going to be owed to somebody. You don't just, the government is it's not just issuing money. And they are, but they have to bring money in to be able to do that. It's not just this. So it's kind of like, okay, well, Elon Musk was getting criticized for it. And my comment back to anybody who studied economics is, how can you possibly argue that there's going to be no cost to this in the future? It's going to come at a cost somehow. It's either going to come in massive inflation. If this went to 10% suddenly, what happens to interest rates then? How do you control inflation?
Interest rates would go up to slow down.
Correct.
Slow down the spending.
So interest rates so if you remember in the 80s, we had like 15% interest rates, actually upwards of 20% interest, right?
Yes.
That was a reaction to the inflation we had.
Something with Jimmy Carter did something?
Well, I'm not going to blame Jimmy Carter. That's an easy cop-out.
Okay.
We had massive inflation, and Paul Volcker with Reagan said, I'm going to increase interest rates. And by the way, he was very unpopular for that. He increased interest rates 15 or 20%. It brought inflation down big time, right? But imagine if you had to buy a home now. What's our interest rate now? I just got Lisa's buying a house.
So I think my folks bought their house at 18%.
That's possible.
Yeah.
But right now, I just quoted a 30-year fixed for Lisa at 2.99%.
It's amazing.
So if this went to 6%, literally her cost on her mortgage doubled. And that's not even where we were there. This was 5 times higher.
Crazy.
So what would happen to real estate prices?
What was happening?
Oh, real estate was down, stocks, everything was down. But it was necessary. And Volcker and Reagan both said, this is what we need to do to get back to normal. It's going to be painful in the short run.
Okay.
And these are the arguments that I make with the recent stimulus package. Do I like the fact that we bailed some people out? Sure. I'm not going to argue that one. But if it's just about bailing people out forever and just giving them money, who's going to write the check to cover that?
As a normal American making $42,000 with 3 kids, should they care about any of this? Should they just keep...
Well, in the short run, of course not. But in the long run, it drastically affects them. Do you think it affects me?
Well, I'm sure it affects everybody.
It's not going to affect me.
Oh,
I'm probably going to make more money because of it.
Oh.
Listen, wealthy people, the funny thing is people complain and say like, oh, wealthy. It's like we criticize wealthy Americans for making a lot of money during downtimes, but then we sit there and look at these things and people don't want to think long-term about these things. The average American making $40,000 a year goes, well, I don't care about that. Well, you should care about that because let me ask you a question. At $42,000 a year, can you afford a $100,000 house at today's market? Yeah. 3% interest?
Yeah, sure.
How about 20% interest? What are you doing? Are you going to own a house? $100,000 house.
Go on.
Call it 10% interest. What's just your interest payment every year?
$10,000.
Yep. And then what about paying down principal?
Oh, I see.
That's going to be another $5,000 or whatever it is. $15,000. Guess what? You make $40,000 after taxes. It's $30,000. You just put half your money away. Oh. Versus before, and this is now at 3%, it's $3,000.
Oh.
Which one's better?
I see.
These things affect everyday Americans more than anybody. Not today, but in the future. You're making $40,000 a year. Inflation's really high. all of a sudden now I got to pay you $80,000. Does it look more attractive or less attractive for me to go overseas or stay here?
Oh, incredibly more attractive to go hire someone.
That's the same person who complains about why are our jobs going overseas? Well, you wanted to be bailed out today. There's no such thing as having your cake and eating it too.
Is the bailout? What if the bailout's just absolutely necessary, Paul?
You're right, and I'm all in favor of some temporary. I think we've gotten past that. The stock market today is literally hitting an all-time high again. Did you know that?
Yeah, I looked at I have the most money I've ever had. I talked to Beth. Boy, Paul, I was trying to describe the idea of what happens when a bubble starts getting bigger and bigger, and it gets thinner, and it just massively big. And at some point, I'm like, how is this? How do we have all this money yet nothing is happening?
Next video we got to do is about coronavirus, and it's when everybody blamed the stock market on coronavirus, and I'm going to sit there and talk about that. Seth, that's exactly it. We bailed everybody out.
Yeah.
Unemployment went to 15%, possibly 20%, now it's down to 10%.
Mm-hmm.
It's coming back down. Guys, if you just want bailout after bailout, somebody's have to pay it. And guess what? If you think for a second it's not going to be everyday Americans and rich people together, but which one can afford it?
The rich people
can afford it. Okay, take away an extra 10% of my income or 20% of my income for a few years. I still had tons of money.
Uh-oh.
But imagine making $50,000 a year, and then we're saying, if you think for a second that somebody making $50,000 a year won't receive the pain of my taxes, you're out of your mind.
So what? Okay, politics aside, what are normal people supposed to do?
Did I mention politics at all?
No, but I guess politics. What are normal people supposed to do if we're heading in this catastrophic trend?
Save your money when times are good. That way we don't need to bail everybody out.
Well, that's the opposite. What I do is when times are good, I go. Well, I have been saved, but most people, when times are good, they're going to go spend and buy. That's.
By the way, I'm not saying don't spend and buy. I'm saying make sure you still save too.
So, Paul, go tell me about this graph.
So this is the CPI that I was talking about before. It shows in January 1950, the consumer price index was 23.5, and today it's 257. That's all this was, and it's just showing over time what happens to prices.
Why was it so flat for 50 years?
Well, that's because of compound interest. It tends to look flat, even though it isn't really flat.
Oh.
So if you look back to 1915, it was 10. So from 1950 to
50% increase.
No, more than that. It went from 10 to 23.5.
Oh,
so
my gosh.
130% increase.
Oh, okay. I didn't see
over 35 years. So that's the whole point. That's the thing that's great about compound interest. It just goes and goes and goes. And someday, if you look back from 1925 to somewhere in the future, it's going to be like this.
Wow, okay.
So inflation is fine. It's not good. It's not bad. It's just how you're going to perceive it. Steady inflation is everybody's best friend. If you own a home, you want steady inflation. You will do very well. We've had 1.5%, 2% inflation for quite a while now.
A little low?
What was that?
It's a little low?
Oh, it's very low.
Yeah.
It's been, look at the last 10 years here. 10 years ago, we were at 218, and now we're at 257. So let's do that same math again. 257 divided by 218 to the power of 1 divided by 10.
I got it, Paul.
You're going to do it? I'm going to check your math, though.
257 divided by
218.
Mm-hmm. How do you do the powers?
X to the Y.
X to the Y, baby. Wow. I'm not going to get this right, Paul.
Well, I'll skip ahead. 1.65%.
Okay. Okay.
So half of what the historical average has been for the last 10 years. So I believe in reverting to the mean. In the 80s, we had really high inflation and really high interest rates. And now we have really low inflation and really low interest rates. 10 years ago, I'd never guessed interest rates would be this low still, but it happened. Would I bet the next 10 years will be higher or lower than this? My guess is higher, but I could be wrong. But a good investor and a good economic person will sit there and say, you make good decisions every single day, and you hope that these things don't affect you too much, but you have enough margin in everything you do that you're fine.
Make the phenomenal decision to smash the like button right now, pretty please, for us. Paul, keep going.
So this is pretty much inflation. People always talk about good and bad. I don't know. It's not good or bad. It just is. It's how you perceive it. Inflation has its benefits. Inflation has its downside. For people who own a home and own real estate, inflation's your friend. Good, steady inflation's your friend. For people, people make the argument for stocks. And by the way, the other funny part is, you better believe the government wants hyperinflation.
Yeah.
Because they have so much debt. The only way to get out of it is really to inflate money so much that the GDP just soars and soars and soars, and the debt stays the same. So as a percentage of GDP, just like your home mortgage, the debt will stay to this level and GDP just keeps going up and up and up. So over time, they'll be able to pay it down faster with future dollars that are overinflated.
Thank you, Paul.
Thank you, Seth.
Subscribe below, like below if you like what you hear. Comment below. Paul will respond with his words. He'll put PG after if it's his response. If not, it's usually Don or I saying
What
hello.
percentage of the responses do I to handle? Probably 90%.
What do you think, Donald?
Because they're all wanting to get that insight from you directly.
Yeah. So I answer.
He answers every time.
I check that thing several times a day.
Thank you, Paul. Thank you, Don.
You're welcome.
And thanks for our listeners. We love having you. And follow along. We have hundreds, not hundreds, but over 160 videos now. Check us out. We go all the way back to 2 years ago. Paul, thanks for your insight on inflation.
Thank you.